During its meeting on April 3rd, 2024, the Monetary Policy Committee, Mpc, retained the central bank rate at 13%. The Mpc noted that its previous measures have lowered inflation, addressed the exchange rate pressures, and anchored inflationary expectations. They also noted that overall inflation is expected to continue to decline in the near term, supported by lower food and fuel prices, and also the pass-through effects of the recent exchange rate appreciation. The Mpc concluded that the current monetary policy stance will ensure that overall inflation continues to decline towards the 5% midpoint of the target range. The Mpc will closely monitor the impact of the policy measures, as well as developments in the global and domestic economy, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in June of 2024. In making that decision, the committee also looked at developments in the global economy, the growth of global economy, and also the financial markets. With regard to global inflation, the committee noted that headline inflation continued to generally ease, but the pace of decline has been below expectations, with some stickiness, particularly in the US. Core inflation has been sticky in the advanced economies, mainly reflecting tight labor markets and high service price inflation. With regards to Melbourne oil prices or fuel prices, the committee noted three things. One was the upward trend in oil prices since January 2024, reflecting high shipping costs arising from the Israel-Palestinian conflict and increased Houthi rebels' attacks on oil tankers in the Red Sea near Yemen. Secondly, the OPEC Plus and allied producers have also extended the voluntary oil production cuts of 2.2 million barrels per day into the second quarter of 2024. And finally, there was the improved demand, partly due to the rising global demand in exerting some upward pressures on oil prices. With regard to food inflation, the committee noted that maize prices and wheat prices have also continued to decline, as well as the edible oil prices. However, sugar prices moderated in February 2024, which reflected improved supply attributed to favorable weather conditions in key growing areas of Brazil. But nonetheless, the inflation for sugar continued to be elevated at 12.5% in February. One of the key risks to the inflation outlook is the potential for increased the disturbances, global geopolitical risks, and already we can see the part of that risk causing an increase in global freight cost, which actually have increased now from a low of $1,077 US dollars for a 40-feet container. That was around just towards the end of last year, to the current price of $3,225. With regard to global production, the situation has not changed very much from our last meeting. The global growth is projected to grow, the world economy is expected to grow by 3.1% in 2023 and also in 2024. However, the growth in 2024 has been adjusted upward by 0.2%, and that is in recognition of improved performance in the United States, whose growth has been revised upwards by 0.6%. Similarly, the growth in China, although it remains low at 4.6%, has been adjusted upward by 0.4%. And finally, the growth in Russia, which was estimated at 2.6%, that has been adjusted upward significantly by 1.5%. The one thing to note here is the projections for Kenya's economic growth, which according to the WIO is 5.1% in 2023, which declines a little bit to 5%, and then 5.3%. But the thing to note is that the growth for Kenya is well above the sub-Saharan Africa average. It's higher than the global average, and also is higher than the emerging market and developing economies average. Finally, on the issue of the global financial markets, we have seen conditions have improved significantly. They've increased risk profile appetite, and there's generally a positive market sentiment, with generally stock exchanges recording significant increases since the beginning of the year. In terms of access to capital markets, we've seen improvement of access by emerging markets and developing economies. We have seen suddenly in the case of Africa, the 3 countries have accessed capital markets this year. Cote d'Ivoire was the first to access and got 2.6 billion in January. This was followed by Kenya, actually Benin, which got 0.7. And of course, Kenya, we got the 1.5, which was for liability management and to offset the expected amortization or maturity of the 2 billion euro bond that is falling due in June. With regard to domestic inflation, inflation has decelerated from 6.9% in February to 5.8% in March. And this has been the result primarily of lower food inflation from 6.9 to 5.8%, but also fuel inflation, which has declined from 13.4 to 12.3%. The non-food, non-fuel inflation has remained broadly unchanged at 3.6. In terms of contributions to the overall inflation in March, you can see that food inflation contributed 2.2 percentage points, and fuel 2.5 percentage points, and finally the non-food, non-fuel 1 percentage point. But the point here to note is that you can see that the contribution of food inflation to overall inflation has declined quite significantly from October 2022, when it contributed 5.7 and is only now contributing 2.2%. And indeed, its contribution to overall inflation is now lower than the contribution from fuel. Looking at the non-food, non-fuel inflation, we've seen that has remained stable, and indeed has fluctuated between 3.3 and roughly 3.8 since July of 2023. And this reflects the impact of the monetary policy measures that the committee has implemented over the last 8 or so months. In terms of the drivers of food inflation, and just looking at the contribution, its contribution to food inflation, again, looking at March, as I said earlier, overall inflation, food inflation was 5.8, which was a decline from 6.9. And we've seen that both the contribution from non-vegetables and also from vegetables has declined. For vegetables, it has been declined from 2.5 to 2.4, and for non-vegetables has had a significant decline from 4.3 to 3.4%. The main drivers of non-vegetable inflation have been maize, wheat, milk, and edible oils. And as you can see, that inflation, in terms of the percentage point contribution to overall GDP, has declined from 3.4 percentage points from September 2022 to actually it became negative in September of 2023, and has remained in negative territory and up to minus 0.2 in March of 2024. Still again on the non-vegetable inflation, sugar prices have continued to decelerate. You can see there that in July of 2023, the inflation was, sugar inflation was 63.6. That has steadily declined to 21.3. It's still significant, but going forward, we do expect that increase to slow down for several reasons. One is because of the base effect. If you look at the graph, you can see that there was a significant increase in May of 2023. So we'd expect May 2023 prices to be elevated. So by the time we reach May of 2024, we should see a significant slowdown in inflation of sugar prices. But at the same time, the reopening of sugar factories from October 2023 has had a positive impact on lowering inflation of sugar. We've also had government measures, including zero rating of sugar imports, which will be extended to June of this year. And then finally, global sugar prices have continued to decline, reflecting increased supply, particularly from countries like Brazil. With regard to the main drivers of vegetable inflation, again, just looking at the very last column on the right, you can see that vegetable inflation was 9%. This was a decline from 9.7 the previous month. But all of it, as you can see, is really accounted for by inflation of prices of onions. Onion inflation was contributed to 9.2 percentage points of that 9%. So it actually contributed even more than the overall contribution of vegetable inflation to the overall inflation. In fact, onion prices have risen by 65.5% this year, and this has reflected reduced domestic supply and production, as well as reduced production in Tanzania. So going forward, we hope the higher prices will incentivize increased production of onions, both in Kenya and Tanzania, and that this high contribution of onions to vegetable inflation will decline over the coming months. With regard to fuel inflation, as I indicated, there was a decline from 13.4 to 12.3, and the main contribution to that reduction in fuel inflation is electricity prices, which declined from 3.7 to 3.3, but also pump prices also declined from 2.8 to 2.2. And really the main reason for this decline in both electricity and pump prices reflected the appreciation of the shilling exchange rate, which resulted in a decrease in electricity prices, but also in the downward adjustment in pump prices. Going forward, in terms of inflationary expectations, we did some surveys, the agricultural survey of March, and generally respondents expect inflation to come down. So compared to the survey in November of 2023, just looking at 1 month forward, in November, 57% of the respondents thought inflation would increase. As of the March 2024 survey, only 40% of respondents thought inflation would increase. So that's a significant decline from 57 to 40%. In terms of 3 months forward looking, 60% of the respondents in November 2023 thought inflation would go up, but only 34% of respondents in the March survey think that inflation will go up. So that's a significant improvement. So generally there is expectation that inflation will improve and decelerate over the coming months. Moving to the domestic economy, again, here we have not really changed anything. We expect the economic growth to remain robust. We expect real GDP to increase by 5.6% in 2023. We also expect that momentum to be sustained into 2024, and for real GDP to grow at 5.7%. The main drivers of this robust growth is the agricultural sector, which continues to grow quite rapidly, reflecting the good weather. For 2023, we expect agriculture to have grown by 6.6%, and then we expect a slowdown to 4.9% in 2024. And the slowdown is just mainly reflecting the fact that 2023 was such a strong performance. And so we expect just from a base point of view, a slowdown in agricultural growth in 2024. But importantly also, we expect manufacturing to start contributing to overall GDP growth. Last year, we estimate that manufacturing grew by 1.9%. But now we are, just because of the government's policies under the bottom-up economic transformation agenda and the focus on manufacturing and value addition, we expect manufacturing to increase to 3%. Although we still believe that this is low, this can be improved. And indeed, over the medium term, we do expect this growth in manufacturing to be a driver of growth in the medium term and to increase by more than the 3% that is shown there. Equally important is the resilience of the services sector, which is estimated to have grown by 6.6% in 2023, and we expect that momentum to be sustained at 6.6% in this current year of 2024. We've also looked at in terms of making our estimates and projections for 2023 and also for 2024. There was one quarter which we don't have data for 2023, and we did look at the composite index of economic indicators, which are leading economic indicators, and we estimate that the fourth quarter of 2023 real GDP will grow by 5.8%. And you can see our previous estimates of actual growth have not differed very much from what is indicated by the composite index. Similarly, we expect a fairly strong first quarter of 2024 at 5.8, so that momentum will be sustained. And also this comes from the surveys that we have undertaken in the agricultural sector. Most respondents in the agricultural sector think not only prices will come down, but also there will be increased production. We also took surveys from CEOs and also from banks and non-banks. And all of them, there was a positive attitude and a positive belief that going forward, the economy will even do better than 2023. Credit to the private sector decelerated in February from 13.8% to 10.3%. But this deceleration is a reflection really of the appreciation of the exchange rate. A certain amount of private sector loans is denominated in dollars, and therefore when the exchange rate appreciated, the level of credit to the private sector did decline, and that's reflected in the slowdown from 13.8 to 10.3. When we strip the exchange rate impact on the credit to the private sector, you can see really that since December, credit to the private sector has remained broadly unchanged at around 8.3 to 8.4%. Moving on to the balance of payments. Again, here I understand it's very difficult to read what's there. Maybe we need to improve on this presentation. But broadly speaking, we have a current account. We have a widening of the current account deficit from about $4 billion to $4.8 billion. And we expect that increase or the overall current account deficit of 4.8 to be financed by the capital account of about $156 million. But more importantly, the financial account of $4.381 billion, and we expect an overall balance of payments surplus of $1.35 billion. And this is the first time really that we are having a surplus since the small surplus we had in 2021. With regard to the current account deficit, last year we estimated the current account deficit to be about 3.8% of GDP. We expect roughly the current account to be around 4%, which we consider to be a sustainable level of current account that will not result in increasing debt levels. For the 12 months to February of 2024, we estimate the current account deficit of about 4.3%, and this is a narrowing of the deficit from 4.7% during the same period last year of February 2023. In terms of the exports of goods and services, last year we experienced a reduction in our total exports by about 2.2%. For the 12 months up to February, we've seen some improvement, and that the reduction in exports is only 1.7% compared to the 2.2% through December. And just looking at the details of the exports, we can see that food and live animals, we experienced there was a positive impact of the 3%. There was also a positive growth in exports of manufactured goods of 1.1%, reflecting mainly the lime and cement, which had a significant increase. And these are really exports of cement to our regional partners. And then for the most part, the others had a negative growth. And at the bottom there, you can see that the total exports have declined by 1.7%. Just to highlight some items, in this case the tea, and we've seen some positive prospects for improved tea exports in 2024, mainly on account of the pickup in global tea prices. Similarly, on the horticultural sector, we've seen some improvement, particularly in terms of production, and the quantities of horticultural exports have increased quite significantly from 480 million kilograms in 2023 to about 640 million kilograms. goods to increase by roughly 11% for the year, and also for the exports, we expect that to increase by roughly 10% for the year as a whole. So looking at the details of imports, again, only food and live animals showed a positive increase, and of course this is a spillover from last year when the government was facilitating the importation of food with a view to reducing the cost of living. Most other import categories, whether it's mineral fuels, there was a reduction of 15%, chemicals, manufactured goods, machinery and transport equipment, all have experienced negative growth in the 12 months to February of 2024. In terms of services, exports, tourist arrivals have improved by 27.6% in the 12 months to January 2024, compared to a similar period in 2023. And for the month of January, the arrivals were 20.3% higher than the same month in 2023. With regard to diaspora remittances, these have continued to be very resilient. For the 2023, there was only an increase of 4% compared to 2022. But for the 12 months to February, we've seen a significant increase in remittances, and so compared to the 12 months to February of 2023, we've seen a significant increase of 7.5. And indeed, if one were to compare the first 2 months, we have data for the first 2 months, January and February. If we were to compare those 2 months, we see remittances for the 2 months compared to the 2 months in 2023 to have increased by more than 20%. Now, for the year as a whole, we have assumed remittances to grow by only 5%, so there may be an upside surprise in terms of the current account, where we have much higher inflows of remittances. In terms of the share of remittances from the non-traditional markets, including the EAC corridor, this has increased. We've seen the U.S. share has been declining since 2022 from 60 to 57 to 55. But on the other hand, non-traditional suppliers of remittances, Saudi Arabia, we've seen the increase from 5.3 to 7.9 and also to 8.7. This is the financial accounts. I think that we've already roughly covered it, but essentially just to show that the amount of inflows in the financial account of at the end of the last column, which is inflows of 4.381 billion, should be sufficient to cover the current account deficit and result in a surplus of the 13.56 that can be seen at the bottom of that table. In terms of the foreign exchange developments, we've seen now that the Kenyan shilling has appreciated, has been appreciating since around, I would say since around February. There's been a significant appreciation of the exchange rate. Perhaps we can come back to that in the question and answer segment. But essentially, this really reflects improved investor confidence in the economy, and the fact that we have been able to address the issues of the Eurobond that is falling due in June. But there's been also a significant increase in foreign exchange resources, and that has impacted the shilling dollar exchange rate to the point now where the shilling is exchanging at roughly 131 shillings to a dollar. In terms of the usable foreign exchange reserves, we have seen a fairly steady increase from the end of 2023, where we had reserves worth $6.5 billion. As of April 2nd, that has risen to $7.1 billion. And as I've indicated, from the balance of payments, we expect this figure to rise by another $1 billion, so that by the end of December of 2024, we should have $8.1 billion of usable foreign exchange reserves, and that will be equivalent to about 4.1 months of import cover. Turning over to the fiscal performance and outlook, we've seen that the envisaged fiscal consolidation over the medium term is expected to reduce growth of public debt and boost our debt sustainability position. The fiscal consolidation will be achieved through broadening of the revenue base and containing non-priority expenditures. So the government continues to be committed to fiscal consolidation by both increasing revenue mobilization, but also containing unproductive expenditures. So we do expect in 2023-2024, the deficit of 5.5% is what had been submitted in the supplementary budget 1, but I'm made to understand that the Treasury is now working with on the supplementary 2, and that fiscal deficit will be reduced significantly. So we do expect going forward that this fiscal deficit will continue to narrow and will therefore move our debt ratios, the debt ratio of the net present value of our debt to GDP which currently is about 68%. That should move towards the target that has been approved by Parliament of 55%. We should be able to reach that level by fiscal year 28-29.